Before we begin this journey into the world of pyramid mastery, I just want to let you know that it's important to ask questions that naturally arise when you embark on something abstruse, exciting and little documented. This is the normal type of pyramid. The biggest trade is done first, 500, the next one's 300 and the third one is 200. Protecting initial risk is one of the most important elements of trading. This is a non-standard pyramid which gets bigger as it goes up, starting with 200, 300 and then 500. The advantages of this will be explained. Hello everybody, I'm Roger. This video is intended for more advanced traders, but some beginners will probably be able to glean something of use from watching it. The textbooks will tell you that pyramid trading should be done in smaller and smaller stages. This advice is generally correct, providing you have a market which has nice, smooth, gentle uptrends which are predictable. These days, cryptos and short-term futures charts have very unpredictable price action. So using a standard pyramid for those markets, which is 532 or thereabouts, can result in a lot of losses on the first trade, which is 500. So it's often very sensible to switch these around, so the smallest trade is first and the biggest trade is last, because then you get the full size on without increasing risk. We're going to be testing Bitcoin, gold, Nvidia, Microsoft and Croda. These are the best settings that I've found with my strategy on Nvidia, and these will never be the same as the best settings on your strategy on Nvidia. So this is important to realize, because there's 1,000 possible sizes for this. 0 to 1,000 to the power of 3 gives 1 billion combinations, and as I want to keep this video shorter than about 27 million years, I've put the steps in increments of 50. So the way this is working, to calculate the pyramid, you first need to know what is your risk. So a normal good trader would be risking about 1% of capital per trade. So you can divide your total equity by 100 and that would give you 1R. So this risk from here, entry price to stop, times the number of shares, contracts, or the point size of a forex, or the point size of a crypto position, must not exceed 1R. The second trade can't be added until it can be added without increasing 1R. So once this goes up enough to lock the stop up a bit higher, then the second trade can be put on. And the stop can be going up if either the market goes up or the volatility reduces. So here you can see the stop's got tighter because it's using ATRs, and therefore we could put the second trade on. The second trade can be added for that reason and that reason alone, or you can be fussy and tell the code to only put the trade on if it's made a new position high. That means the highest high since the position was started. This is a kind of point of contention. So if you wait for the new high, you get a worse price, but it's generally safer because the market's actually doing something. If you add to your trade during a correction whilst the trend is still up, you're not quite so confident to add it because it might be the beginning of a move down. And then the third trade is added when R2 and R1 are adding up to less than R1 was at the beginning. So here this is like less than half it was at the beginning, and when we get to here, R1 is completely vaporized and is now a positive number, and R2 is very small, so you get a third trade on. If this trade was the upside down pyramid, say starting with 200, 300 and 500, these trades would have to be much further up the ladder because there's so much more movement in the stop loss required to lock in R1 into a riskless position, or reduced enough to get the next one on. So this is using high minus ATR times 6. It's very important to understand that this is an adjustable factor. So high minus 6 ATRs brings us to here. In this case, high minus 6 ATRs brings us to here. So the high minus ATR is better with difficult markets such as cryptos, for example. I'll explain this to you first with relative comparison. So a lot of systems, including some that I use, we use the low as a stop. This could be the 20 bar low. This would ensure that your stop is going up steadily as the price goes up, but it doesn't track the high. So in a crypto boom, which we're here at about 6, the crypto could suddenly go up to 100 and then go all the way back down to 5, and you'd get stopped out at the low, meaning you'd be completely disengorged of this huge paper profit if you were using the low as a stop. If you're using a high minus ATRs, true say, the ATRs would be wider, and this went up to 100, you might get stopped out at 85 or something like that, but you would have retained a very large amount of this paper profit and banked it. So there's pros and cons to each method, and again, this is something you have to decide for yourself basis of the market. This is the basic reason why I've used it, because with a spiky market you've got more chance of getting some of the paper profits back into your account instead of vaporized up in smoke. So now we look at the strategy performance report, and you can see the volatility is all on the big side when the money's coming in, and this is because the entry price volatility, as you're vesting up, you're stepping in little steps, so the volatility on the entry is much less, and the volatility is when you got the full size of the trade on. This is amplified with this stock because we're starting off life at $5 or so, and if you look at the end of it, we're up to $139, and remember this stock has already had a 10 for 1 because it went up so much. These numbers, this represents the risk. So we start off with a positive risk, 6,000, which turns into a negative risk, so that's like minus 7,000, which is what you would get in profit if you were stopped out. It's a very important thing to keep a track of what the risk is at each stage. This is Microsoft now, and unimpressively the highest profitable result came with setting this to 998, 1 and 1. So basically in the whole thing at the beginning proved more profitable than all the other tests. However, in terms of the managed account report, which is a metric I like to use, which is the profit percentage divided by the biggest drawdown percentage, this turned out to be the best setting in terms of a strategy that one can use without having a heart attack. That's the best way to describe it. 600, 200, 200, and if we look at the strategy report, this is over 10 years, 36 trades, 72% wins, 1.92 risk reward ratio. The important thing is the shape. So if you look at this little bit here, this is unrealized profit that was taken back by getting stopped out. Here there was a downtrend, so there's hardly any trades because the EMAs weren't crossing over. And there's 1, 2, 3 fake signals followed by some good news. The next one will be Bitcoin. So this is the equity curve of Bitcoin, and this is an upside down pyramid, and the shape of this equity curve exemplifies the beauty, truly exemplifies the beauty of the upside down pyramid in a difficult market. So you can see the volatility in these sideways spills is very low. This is the first and the second entry. It's the first, second, stopped out, first, second, stopped out, and then there's a big win, bam. So all the volatility is on the winning trade, the biggest one. You can see we went all the way up to about 32 million and back down to about 17 million. True say, heart attack stuff. But if that was minus, it would be much worse. You must agree, right? So this shows why upside down pyramids can be useful. This is what they look like, the equity curve with upside down pyramids on markets like Bitcoin. Let's just look at the chart now, and you can see we start with 250 and we go to 300 and we go to 450. All these tests had very big drawdowns, so this one was around 76%, which is pretty horrible, but it is what it is. This is an old English stock called Croda, and it's a very good example of demonstrating why an upside down pyramid can be very useful. The size is 100, 200 and 700, and the equity curve is incredibly unusual. So basically it made all the money in 2 trades and waited a long time for anything to happen. So if you can imagine using this on the S&P futures on like 20-minute data or 10-minute data, you can see when you get those big moves, when the news comes, you'll have something like this, and the rest of the time you'll be getting this, and hopefully they'll add up to loads of these booms going up. This stock has had it's very normal progress, nothing much exciting, and then it had still wasn't that exciting, went up from 5,000 to 10,500, but this particular leg from here, we caught the stage 3 until getting stopped out there, and that was where all the money was made. Quite incredible. This is a chart of gold, and the best settings, just like Microsoft, turned out to be putting the whole lot on in the first instance. But the best pyramid shape to get the best managed account report, which again is the total net profit percent divided by the biggest drawdown percent, was 600, 300 and 100. And the equity curve was nothing special, not particularly eventful. So not all markets benefit from pyramiding, but there's a lot of key takeaways which we can go over now. So the first point is that pyramid entries always give a worse entry price. That's if you're following the method as I am, which is waiting for the stop loss to lock in the profit of the first trade before adding the second, and the same for the second one to go up before adding the third. And this is the strategy that was used by the great Jesse Livermore, who made $100 million way back in 1929, and also Nicholas Davos, who wrote the book about the box system, and he was a dancer, and he was a very clever guy. He didn't know what he was doing, and he figured out this strategy, and nobody believed him until he'd proved it. Key takeaway number 2, why bother doing pyramiding? Why should you bother? Well, it enables you to get a big size, bigger than you normally would have, without increasing your initial risk. So remember, we talked about R1 is your initial risk, and by the time the stops moved up enough to get R2 and R3 in position, providing it doesn't gap through your stop, then you've got a bigger trade without increasing risk, and the price you pay for that is the worst entry price. Key takeaway number 3, different market types need different pyramid styles. Smoother markets, such as the ones we've looked at, Microsoft and gold, often do better with the biggest trade first and the smallest one last. Spiky, chaotic markets, and also stocks which are kind of normal and then they suddenly do something, these can benefit from the upside down pyramid shape. The variations you can get in equity curves are pretty much infinite, If you think about all the settings, there's a billion different settings just for 3 entries, and that's without changing any of the parameters of the stop loss or the system or the entry or the time frame. So we end up with an infinite amount of possibilities. And there's all the markets as well. So there's a lot of testing to do, but it's important to test in wide increments, otherwise you'll just use up all the electricity in the world testing. Okay, key takeaway number 5. If size 2 is substantially bigger than size 1, it requires a much greater move up before the risk is reduced enough to enter the second trade. And the same applies to the third. Key takeaway number 6. If you go back in time and look at the early price action of good stocks like Microsoft, Google, Amazon, Nvidia, and see how they behaved, and find other stocks which you think are going to perform like them, get in early. The price action of things like that is very suited to pyramid trading. Key takeaway number 7. Pyramid trading requires the patience of Jonah. Key takeaway number 8. Equal size pyramids are often a good approximation to start testing with. And again, Jesse Livermore and Nick Davos, they were known for using equal sides for their second, the third, the fourth, sometimes 5 ads. I think sometimes they did 6. And my product, which is called HAT6, which is a hyper adaptable trading system, has 6 entries, and there's an unlimited version which works with TradeStation and multi-charts, which I'll show you shortly. Now we are in the NinjaTrader platform, and this is the FDAX on a 3-minute chart, and this is HAT6 for NinjaTrader, which can do 6 entries at equal size on the long and the short side. Because we're in a bull market, it's set to do 6 long and 3 short, but that's up to you. You don't have to take the shorts. So it basically adjusts itself all the time, and these boxes signify when it's going to switch. So it looks at what the box was, the last bar. So here the box is here, and it's just punctured it, so it's covered one of the shorts, making it short 2, and it's entered it again here, making it short 3, and there it's covering the shorts, and there it's going long because that surpassed the box, and then it's long again here. The DAX is one of the more trendy of the futures, and HAT6 does well with it. We're very close to the standard settings. I've just adjusted the sensitivity. So since 2022 it's taken a little over $1 million out, and most of that's come from long trades, as you would expect, as the market's been going up. 80,000 and nearly 81,000 on shorts. Another takeaway, this is something which a lot of beginner traders make the mistake thinking that the percent profitable is the most important thing, and it is not the most important thing by any means. The ratio between the risk reward ratio and the percent profitable is what matters. So if you look at the equity curve, we've got 36, say 37% profitable, and we end up 36% profitable. We end up with an equity curve like that, which is very handsome. But the patience is required here between July 23 and April 2024. There wasn't any money to be made on these settings. However, if you adjust it, you'll be able to find some settings that probably run through the whole period in profit. They might be less favorable here, they might be less favorable here. The idea is to find something which works well in every market. If this is low, then this has to be high. So 2.2 risk reward ratio is pretty high. You can get ridiculous ratios if you've got a very long term position running up and up and up and up, and this doesn't matter so much. If you've got a strategy that takes profits quickly, you need the percent profitable to be much higher than that. but this isn't that kind of strategy. This is a strategy that runs and runs its winners, which is what winning traders do. And you can find an abstruse way of realizing pyramiding is good if you take the polar opposite of what losing traders do. So losing traders typically cut their winners because they're afraid they'll turn into losers, and they let their losers get bigger because they hope they'll go up. This is actually the wrong way to do things, and that's why it's an effective strategy, and it's been used by a lot of great traders over the years. So this is Hat 6. You can get a trial for NinjaTrader and TradeStation and multi-chart. The NinjaTrader version has 6 blocks. So these are equal sizes, okay? So you can set the long size whatever you want, or the short size to whatever you want. Every entry, the 1, 2, 3, 4, 5, 6, they'll be the same. So we want, say you want 3 contracts and you want 4 entries, and the short side you want 2 contracts and you want 4 entries. They're all the same size, each one, but that's not a bad thing by any means. And then the strategy will set itself up differently. We'll have a totally different equity curve, 2.3 million. Okay, that's even better than it was before. So it's actually started climbing out of the boredom a little earlier than the last one. Just to recap, the key takeaway with this product is they're all the same size. Each entry is the same, but you can adjust it up to a maximum of 6 entries. The TradeStation and multi-charts versions, they allow unlimited entries. This is another thing that you've got to get right. If you keep adding and adding and adding, your entry price average is going up and up and up, and the objective is to keep the entry price low, the average entry price low. And by adding up here, then you're raising your entry price, and therefore you're going to affect your ratios drastically to the negative. So that's an important thing to take away. This is yesterday's price action. Very nice bunch of shorts and a nice sell-off. So if you've got any questions about anything, please feel free to drop me an email or leave a comment. If you've done any testing on pyramids and you've got any observations you want to share which have not been covered in my video, please do leave a comment, because I'm always interested to try new things, and this is the most important thing for trading, to keep learning. Nobody knows everything. It's always good to hear from other traders and listen to their woes and happy stories, because it's always nice to know. I'll leave a link in the description to the page for Hat 6, and also a link to the page about pyramiding. Thanks very much for watching. If you feel that you've learned anything today, please feel free to subscribe to the channel.